Valuation techniques and financial analysis. Understanding methods for assessing investment value. Agenda. Overview of valuation techniques. Dividend discount model, DDM. Earnings per share, EPS. Price earnings ratio, PE ratio. Net asset value, NAV per share. Purpose of valuation in finance, asset valuation. Valuation provides an estimation of the worth of an asset, essential for informed investment choices. Investment decisions. Accurate valuation informs investors on whether to buy, hold, or sell investments in the market. Mergers and acquisitions. Valuation plays a key role in mergers and acquisitions, helping to assess the value of companies involved. Types of valuation methods. Income-based approaches. Income-based approaches like the discounted cash flow DCF method evaluate a company's worth based on its expected future cash flows. Market-based approaches. Market-based approaches such as comparables determine a company's value based on the market prices of similar companies. Asset-based methods. Asset-based methods focus on a company's net assets, providing a valuation based on the total value of its assets minus liabilities. Importance of accurate valuation, avoiding overpayment. Accurate valuation helps investors avoid overpaying for assets, ensuring better investment decisions and financial outcomes. Assessing potential risks. Accurate valuation is essential for assessing potential risks associated with investments, leading to informed decisions. Impact on corporate finance. Valuation affects corporate finance decisions, influencing mergers, acquisitions, and overall financial strategy. Building investor confidence. Accurate valuation enhances investor confidence, fostering trust in financial markets and investment opportunities. Dividend discount model, DDM. Basic principles of DDM. Value of future dividends. The DDM states that the value of a stock is the sum of its future dividend payments, reflecting its potential earnings. Present value calculation. Future dividends are discounted to present value, allowing investors to understand the current worth of potential returns. Applicability to stable companies. The DDM is particularly beneficial for companies with consistent dividend payments, making it easier to predict stock value. Gordon's growth model. Constant dividend growth. Gordon's growth model assumes that dividends will grow at a constant rate, which simplifies valuation. Valuation simplification. The model simplifies the valuation process for companies with predictable dividend growth, making it easier for investors. Predictable dividend growth. This model is particularly useful for companies that have a history of stable and predictable dividend payments. Assumptions and limitations of DDM. Key assumptions. DDM is based on assumptions such as constant dividend growth and the consistent availability of dividends from companies. Limitations of DDM. DDM is not applicable to companies that do not pay dividends, limiting its use in certain sectors. Sensitivity to growth rates. The model is highly sensitive to growth rate assumptions, which can significantly affect valuation outcomes. Earnings per share, EPS. Understanding EPS. Earnings per share is a key financial metric indicating a company's profitability on a per share basis. Calculation method. EPS is calculated by dividing the net income by the number of outstanding shares, reflecting financial health. Indicator of performance. EPS serves as an important indicator for investors to assess a company's financial performance over time. Implications of EPS for investors. Understanding EPS. Earnings per share is a key financial metric that indicates a company's profitability on a per share basis. Performance indicator. Higher EPS often signals better financial performance, making the company appealing to investors seeking growth. Attracting investors. Investors often look for companies with higher EPS as it indicates potential for higher returns and profitability. Limitations of EPS as a valuation metric. Manipulation risk. EPS can be manipulated through various accounting practices, leading to potential misrepresentation of a company's financial health. Excludes important factors. EPS does not take into account critical factors like debt levels or cash flow, which are essential for accurate valuation assessments. Limited scope. Relying solely on EPS for valuation can provide a limited view of a company's overall financial performance and potential risks. Price earnings ratio, PE ratio. What is PE ratio? The PE ratio or price to earnings ratio measures a company's current share price relative to its per share earnings. How to calculate PE ratio? To calculate the PE ratio, divide the market price per share by the earnings per share to gain insights into valuation. Investor insights. The PE ratio provides investors insight into how much they are willing to pay for each dollar of earnings. Interpreting PE ratios, high PE ratio implications. A high PE ratio might indicate that a stock is considered overvalued, reflecting investor optimism about future growth. Low PE ratio signals. Conversely, a low PE ratio may suggest that a stock is undervalued or that performance expectations are low. Advantages and disadvantages of using PE ratios. Easy calculation. The PE ratio is straightforward to calculate, providing a quick measure for comparing companies' valuations. Widely understood metric. It is a well known metric among investors, facilitating discussions and comparisons across various sectors. Potential misleading insights. Using the PE ratio in isolation can lead to misleading investment decisions, disregarding critical factors like growth and debt. Ignoring growth rates. The PE ratio does not account for future growth rates, which can misrepresent a company's potential value. Net asset value, NAV per share. Understanding NAV. NAV per share represents the intrinsic value of each share, helping investors assess a company's worth. Calculation formula. NAV per share is calculated by deducting total liabilities from total assets and dividing by outstanding shares. Investor insights. Calculating NAV per share provides valuable insights for investors regarding the value of their shares. Applications in investment funds and real estate. Understanding NAV in investment funds. NAV is crucial for investment funds, helping investors assess the value of the investment shares accurately. NAV for real estate evaluation. In real estate, NAV assists in evaluating properties, providing a clear picture of their net asset value. Comparing NAV per share with other valuation metrics. Understanding NAV per share. NAV per share provides a clear benchmark for evaluating the value of a company's shares against its net assets. PE ratio overview. The price to earnings ratio is commonly used metric that compares a company's current share price to its earnings per share. Dividend discount model, DDM. The dividend discount model values a company's stock based on the theory that its worth is derived from its future dividend payments. Comprehensive valuation insight. Comparing NAV with PE and DDM provides investors with a multifaceted view of a company's financial health and investment potential. Conclusion. Importance of valuation. Valuation techniques are crucial for understanding a company's financial health and worth in the market. Informed investment decisions. Proper application of valuation techniques empowers investors to make informed decisions regarding their investments. Accurate value assessment. Understanding valuation methods aids in accurately assessing a company's value, essential for investment strategies. Thank you.